Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. Today I discuss the earnings season for community and regional banks, which will be key in the second half of July. My first blip is making some general observations about the finance sector, focusing on the regional banking index, the BKX. The BKX bounced off levels not seen since January 1997 yesterday morning. When technicals become oversold on monthly, weekly, and daily charts, I assume that bad news is priced in, and this is the case for regional banks. The BKX held my monthly support at 55.80 on Tuesday. Most publicly traded FDIC-insured financial institutions report in the second half of July and are starting to bounce off major lows set as Tuesday's FDIC conference began. The earnings surprises will likely be negative, but with so many of these banks trading at levels not seen since the 1990s, bad news is factored into the major regional banks. Community banks face survival concerns, and these are a case-by-case story. My second blip compares earnings reports to the FDIC quarterly banking profile. With the Ides of July 2008 come the next wave of earnings from more than 1,000 publicly traded community and regional banks, and the question is, how much camouflaging can the banks continue to use in reporting results? Investors need to be aware that earnings reports do not include data the FDIC-insured financial institutions are required to report for the quarterly banking profile, which gets into more details of loan category exposures. We will have to wait for this data for the second quarter towards the end of August. As of the end of the first quarter of 2008, 2,535 FDIC-insured institutions had C&D loan concentrations of 100% or greater to Tier 1 capital. FDIC Chair Sheila Bair said yesterday that at the FDIC conference that the list of problem banks now exceeds 90, the number published for the Q1 2008 Quarterly Banking Index. My third blip looks at exposures to construction and development loans, which are finally in the headlines. What we know now is that $45 billion of the $632 billion of C&D loans were delinquent at the end of the first quarter. Banks have been giving home builders and developers some slack by keeping loans current, expecting a second-half recovery in the housing market, which I have consistently said would not come. With increasing foreclosures and stubbornly high mortgage rates relative to U.S. Treasury yields, banks can no longer be patient with builders. My fourth blip looks at the monthly chart for the Dow Industrial Average, as that's the key chart now. My second half target continues to be my annual support at 10,747. The 120-month moving average is 10,566, and the Dow has been above this moving average since 1982. In addition, the 120-month held at the October 2002 and March 2003 lows. A monthly close below would warn that we face a multi-year bear market. On June 23rd, I touted the 200-week simple moving average as support. It's now resistance at 11,683. If you have any comments or questions, shoot me an email, gmcreports@aol.com. That's today's 4 in 4. Enjoy your day.